really enjoyed the previous session. For the next 25 minutes, you're going to hear myself, David Levinson of Nedgroup Investments, as we do a whirlwind tour of the world with responsible investing, looking at three key areas being social equity, climate change, and last but not least, ESG regulation. So for anybody that has followed the responsible investment journey in South Africa, you'll know that Delphine Govender of Perpetua Investment Managers has been central to the local discussion. So Delphine, thank you very much for joining us today and really look forward to chatting.
It's great to be here, David.
Wonderful. I want to start with social equity and diversity and inclusion, because I know at Perpetua it's something you hold close to heart, and the viewers out there probably get daily emails with diversity, inclusion, social equity, etc. Littered on the titles. So through your words, what is diversity and inclusion to you? And in your experience, what have been the benefits of it?
Sure. And I think, the topic is very prevalent, probably more so now than perhaps 10 years ago or 20 years ago when we first started in the industry. I think, and you're correct to highlight it. And in fact, Trevor's comments just now on the World Cup rugby team, in fact, speak exactly to this point. So interestingly, as much as you've asked from my perspective, I think what's probably more important is that we've typically concentrated our view on diversity very much in almost the social demographics of race and gender. The CFA Institute, as you know, the global kind of gold standard investment organization, recently put out a DEI code, which stands for diversity, equity, and inclusion. And in fact, I quite like their definition of diversity. And they basically say diversity is the full spectrum of human attributes, perspectives, identities, and backgrounds. And I think that really captures everything. The reality is why this conversation has become so relevant to the investment management industry is because if we go back historically, the investment management industry has typically attracted and recruited by a very narrow pool of talent, very homogenous and very much connected to one population demographic, despite the fact that actually, as we know, talent is distributed across all. And over the successive generations, that's sort of, each, leadership team has almost not had the knowledge or the experience or perhaps even the motivation to change that. But now we're seeing that is changing. And I guess the question you might ask is, well, why is it changing? Why does diversity matter? Why did diversity matter to the success of the rugby team? And why does it matter in success of investing today? And I think it goes back to how we perceive investing. Investing is very much a knowledge-based industry. It's intellectual capital. And therefore, typically, we've always seen that in a knowledge-based industry, success typically is all about technical domain expertise. It's about knowledge. And so we've typically always associated that, investment teams have hired to almost create, little mirror images of each other in that domain, in technical expertise and domain. And as the years have passed and as we've modeled and looked at actually the better performing investment teams, the better investors, we've started to see it's actually much more about knowledge. It's actually judgment. And judgment is this combination of technicals, but also behaviors. So the better investors have actually not just mastered their knowledge and their technique or their technical understanding, but actually they've mastered their egos. They've mastered their emotions. They've mastered their biases. And so now we're starting to see that actually as we build teams, what we don't want are teams that are echo chambers of each other, just purely on one way of seeing the world. And in fact, diversity now, whether it's in rugby or whether it's in investing, is actually leading to far better investment outcomes and ultimately serving communities and societies and investors better. And I think the last point I wanted to add on this is that because we've attached knowledge and domain expertise so closely to investing, we've seen that has been almost the transmission mechanism of meritocracy. And in fact, the challenge is that actually the truth is that you really cannot deliver high performance and a meritocratic outcome unless you have a diverse team to begin with. Right. Otherwise, all you're really doing is delivering a meritocracy among a very narrow, homogenous group.
Yeah. I loved your analogy there on the Springboks. We had a lady called Fadzi Wandi on a webinar about 2 years ago. So she's a DI expert at the United Nations. And she'd use the analogy of diversity is the ingredients for your cake. So your flour, your egg, your sugar. And then the wonderful product, the cake at the end, is your inclusion once you put that mixture all together. And that's the cheesecake I enjoy on my Saturday evening. So I really appreciate your take there. And it moves purely beyond purely things like background and gender, but it's also around that inclusion as well as the cognitive side of things as well, which I think we're starting to realize a lot better now. I hope this clicker works. I want to bring up a slide here. So This was in a recent Economist, I think a couple of weeks ago, that a lot of research has been done around the US listed companies and how they've progressed from a representation point of view, looking along gender lines, ethnic lines. You can see some improvement through time, which has been intentional. I'm struggling a little bit to find some data what's happening here in South Africa. I'm not sure how the rate of progress has been. I mean, in your view, this is something you guys look at. Are we championing it enough, and have corporate and listed South Africa moved swiftly enough in this space?
Look, I think whenever you're measuring any shifts, the data is paramount, and data typically is an issue because the question is, what are you measuring? And also who is providing the data. So you're correct in identifying that it is a little bit of a struggle to work out exactly how we compare apples with apples, particularly given from a gender and a race perspective, but particularly a gender perspective. The whole diversity pursuit is something that is very much a global one. In South Africa, I think we are making progress. So there clearly is progress compared to a decade or 2 decades ago. Always with any shift, and whenever you're shifting any sort of status quo from one space to one that is much more inclusive, you're going to need to have multiple almost initiatives to achieve that end game. There's no single silver bullet. Interestingly, in South Africa, the last data I saw was from the University of Stellenbosch that delivered, for example, just on the gender element, a study on women on boards. And there we saw amongst JSE listed companies, around 20% of women in boards. That number has increased, but I'm waiting for the updated report. Interestingly, the sustainable stock exchanges. So the public market space is probably one of the best ways to actually almost compel for this shift. Because the JSE, as we know, has now included in their listing requirements that boards must almost articulate their policy around race and gender progress and equality pursuit, then also report it annually and then report the progress. So that's a good thing. It's still voluntary per se, elements of what your targets should be. What is missing, perhaps a contentious thing, is the gender pay gap differences, and perhaps that will really be quite revealing. And as we've seen, the JSE among the G20, in fact, it actually has the best gender representation on boards among the top 100 issuers. So that number is around 28.5%, better than, in fact, most of the other developing countries. And we've got some of the European countries that have hit over 45%. So in truth, what we should be targeting is not necessarily 30, but 50. If you're going to get to parity. But my point is that I think we're definitely seeing progress, and the more and more it's become a function of elements that companies and boards and investors are starting to understand. It's not just a number to target, for a tick box, but actually is delivering a better outcome in the management of a business, and therefore for shareholders, we'll start to see these numbers be meaningful.
Yeah, and on some of those numbers and data, I know the EU were targeting 40%. I think they drew a line in the sand. There's a body called the 30% Club.
That's right.
Which looks to get 30% female representation on global listed companies. Interestingly enough, our MPs in Parliament, I think, are maybe just north of 50% are female, which is incredibly progressive in the context of a national government. And I remember when I was an ESG analyst, going back 8 years ago, one of the top retailers in South Africa had something like 16 board members and one female on the board. And when you consider that, I think 78% of household decision makings from a purchase point of view are made by the female of the house, and then you have a board not representative of the staff or the clients that they cater for strategically, that's likely a disadvantage.
Absolutely.
Something we can chat about for a while,
yes.
But we're doing on a whirlwind trip as I promised. So on to the next portion of today is around climate change, which is obviously becoming increasingly prevalent. I'm going to see if this next slide works. Sorry, I'm jumping ahead here. So the International Energy Agency has done a lot of work around what power generation has done, and the developing world has actually taken over the developed world in terms of energy demand. But the question around, as we approach COP, which is in the first sort of 2 weeks of December, all these wonderful promises get made by the developed countries to finance climate mitigation and adaptation in the developed world, and we talk to the tune of billions, if not even hundreds of billions of dollars. So a question we get asked fairly frequently from our clients is, as investors, how do we gain access to the investment proposition of this energy transition? And the minerals on the right-hand side that you see there, they are central to things like solar power, wind power, electric vehicles, etc. So as an SA investor, is there any opportunity set locally, or do we need to go offshore to get access to this?
Well, I think there's two ways of doing this. And I think it's a brilliant question. And if anything, one of the kind of cohorts of almost the value chain that should be speaking to each other more are the actual, producers, transmission and generators of power in their various forms of renewable, and then the providers of capital. In fact, most of the conversations that I've heard don't seem to include the two. And when I talk about providers of capital, I mean more the long-term capital as opposed to bank funding capital. So the institutional investors and pools of capital that typically have longer duration and longer liability payoff can actually very much participate in sort of the generation funding. But that sort of has not happened to date. So the reality is, firstly, you can participate by directly being part of a pool or a vehicle. Typically, it's unlisted. The point we need to get to is whether we can have almost a listed entity of unlisted access, or to private credit or private equity that would make it more accessible and more liquid for the average investor. And then the other areas, obviously, then the downstream, the participants, those that produce these underlying resources like steel, copper, aluminium. That's typically how we've been playing it because we haven't been able to access the actual funds that are funding power generation, etc., or even funding the entire energy transition, whether it would be from a transmission or a distribution perspective or purely just generation. So what we're seeing is even the banks, as an example, are a derivative of this. So banks are making an inordinate amount of potential super profits through funding this exact energy transmission. So the average investor is now looking for ways in which they can participate in almost a more creative way. And in fact, for most of the businesses that we're seeing that are struggling to find nodes of growth, energy transition is the one area of growth. So perhaps for the first couple of years, it's going to be more of a derivative play, meaning when I say derivative, the entities that are deriving from the value chain. And then perhaps in a couple of years' time, more direct in terms of instruments that will give you exposure directly to the energy transition, and particularly from a generation perspective.
Because I guess on the debt side, the session before I spoke a little bit about Eskom, and we're going to think positively here, but one of the spin-offs has been the private sector actually investing in renewables. Yes. I mean, I think it was Anglo-America up to the tune of almost 3 gigawatts. So when you think of our national capacity being around 45, you're looking at almost 6% of your national capacity being generated by a single corporate, which I think is quite stunning. And as these solar prices really start to plummet, in the last REAP, or Renewable Energy Independent Power Producer Procurement Program.
Got it right.
Got that correct. Yeah, our economics colleagues on the side here. I don't know, wind or solar is probably close to around 60 cents. Whereas coal, Medupi and Kasili, we won't go into the numbers, but I imagine probably north of R1. So the economics start to make sense, while also being sensitive to the social implications. When you think about something like coal, employing around 100,000 people directly, and then of course the dependence, you can see the social impact that this has. So when we talk about a JPET or a just energy transition plan, it's taking that social element into consideration as well. So on that, I want to move into regulation, and particularly carbon regulation. So something that's been material in sustainability and responsible investment recently is the CBAM, or the Carbon Border Adjustment Mechanism, as introduced by the European Union, effectively putting a tax on the carbon consumed and the intensity within a production and the product itself. So as South African companies look to export, this is a key risk and can affect the cost of your product in the European Union. So for someone who's analyzing these companies, is this a new risk that you're looking at? Is it something that is material? And are you looking for companies that are able to pivot in terms of maybe greening their products or their manufacturing processes? Yeah. Because I imagine that the capex will be quite large for some of these heavy emitters.
Yeah. No, I think, CBAM, like perhaps almost any cross-border tax by its very nature or design, is really looking to affect global trade, impact it, whether positively or negatively. In this case, clearly negatively, to the extent that it's trying to neutralize the cost at which, carbon expenditure occurs in imports versus how much it would cost to produce locally, which is already subject to a much higher bar. And I guess what we're finding is that the sorts of industries that are already going to be affected by this carbon, by CBAM, are the likes of, cement, steel, iron, fertilizers, aluminium. Yep. Those are already industries that are potentially already higher risk in terms of needing to green their business model. Yep. So what we're finding is that, yes, CBAM potentially is accelerating because it's imminent. The pace at which one needs to account for the level of profitability. So clearly it's going to be more costly to produce. We're finding those were industries we were already sensitive to. So to summarize, my sense is that we've already put higher costs of capital on companies that operate in those industries. The question is, do we need to increase those more? And perhaps what's happening is that you are tending to deprive extreme amounts of capital to those industries anyway, not significantly, but just because the bar and your threshold has now become much higher. And CBAM just affirms this, is what we're finding.
Thank you very much. I know the government have highlighted something like green hydrogen as an avenue for growth, and that will be transitionary and revolutionary for industries such as, I think, cement and steel in terms of lowering their emissions, as you touched on. The final section for our session today, and it doesn't always get people jumping out of bed when you talk about regulation, but the ESG regulation space from a practitioner's point of view has been absolutely fascinating. There's been this transatlantic divide, if that's the right word to use, where this tension, particularly in the US, where ESG has become quite politicized, and depending on whether you're in a red state or blue state, your opinion may differ. The Economist also brought out quite a provoking article calling for the split in the ESG being an ugly acronym, focusing that asset managers should focus on environment and emissions because that is the biggest challenge of our generation, if not the century. You've seen Larry Fink in his letter to investors and corporates do away with the term ESG. Vanguard quite famously pulled out of the Net Zero Asset Managers Initiative for various reasons that have been misconstrued by the anti-ESG movement. But on the same side, or at least on the opposite side of the Atlantic, you're seeing the European Union almost go full steam ahead with their regulation, or the SFDR, Sustainable Finance Disclosure Regulation, not without its bumps. A few arguments along the way, but they've certainly progressed in that space. So, Delphine, these global bodies, I know Perpetua are signatories to the PRI, or Principles for Responsible Investing, as well as Climate Action 100. In your view, what has your experience been firstly as a member? And in your view, have they been successful in achieving what they set out to do?
Firstly, I think the point is, and as we're seeing with the examples you used with BlackRock and Vanguard, I'd say the potential danger of something becoming almost that should be a journey, becoming too faddish too quickly, you end up with these kind of extreme reactions, and you end up with this sort of polarization. And unfortunately, I think perhaps through COVID, there was an acceleration in almost a faddishness of that, or that made it purported for ESG to become almost faddish. If anything, any of us that speak about these things, these are 20, 30, 50, lifelong journeys. There's our approaches. And if we started to locate the ESG conversation and responsible investing conversation much more under the stewardship umbrella, this is just a way to invest. This is not just a box to tick or something that we have to do. It's a way to be. It's a mindset. And so as we've started to understand the shift here, one of the most important things, and so you've started to see, reactions. And it's unfortunate that it's almost, with the words like politicized, weaponized, demonized are typically the words that are now starting to be attached. Because it tends to potentially take away from the big goal. And the big goal is the journey we're on, the journey to, being stewards that understand that our decisions around capital allocation, how we manage it, the businesses we invest in, affect society for the long term, affect communities and economies for the long term. And so when we come back to these collaboration bodies, why do we join them? What have we discovered? And interestingly, one of Vanguard's reasons for going at it alone, so to speak, was that they wanted to maintain some independence around how they made decisions. I think it's always a little bit trickier for index funds because they almost are permanent capital providers. But there's definitely room, we think, for collaboration, particularly because the initiatives of the day are societal initiatives. This is not just one investor's view around a specific, issue or around a specific board member or something that is quite unique. What you find with collaborations like, for example, the Climate Action 100, is that you can bring a weight of collective view. You can therefore have better influence. And actually, it's a much more efficient outcome if you think about it. I think where collaborations and collective engagement can sometimes be problematic is that, or where they can fall down, I should say, is that we tend to focus on the issues that divide or that we can't get agreement on, rather than the vast weight of issues that we agree on. And so we're finding that if, in that instance, we use Climate Action 100 very much to say, well, these are the areas that we all agree on, and those can tend to be quite universal. And together we can create quite a lot of influence. There's always going to be the fringe.
Yeah, sure. I have so many follow-on questions from everything you've just said there. Wonderfully articulated. The clock is screaming 1 minute at us.
Okay.
So I guess maybe the parting question is, we are seeing the physical effects of climate change here in South Africa, whether it's prolonged droughts, dry conditions, more variable rainfall, so the flooding we saw here in the Western Cape, KZN, for example, as well, extreme temperatures. In your discussions with corporate South Africa and some of the listed entities, are they taking some of these risks seriously enough on board? Do they have the right people in place, the right strategies in place? And are they responsive to shareholder concerns around these issues?
Yeah. The short answer is yes, they are. The longer answer is that it was not going to happen overnight. This is very much a journey. And in fact, different corporates are at very different points along where they are. I'd say the comforting thing is that this is no longer just the sort of tick box question we have in a checklist of questions in a management engagement. This is now a much more meaningful engagement, and companies themselves are fortunately a lot more proactive around how they're bringing this information to bear. The biggest risk I think we run is that companies could overshoot because they need to be seen to be attaching targets. And so that when you lead down the path of greenwashing, saying that you're going to do something that you don't really have the ability. So I guess our point is that to keep the engagements honest and progressive, and also to make the quality of the interaction, the feedback, not one that is very stick-like, but much more of a carrot-like conversation with clear deliverables to get us to see how they're going to meet, whether it's a 2030, 2040, 2050 goal.
Yeah, I think it's a very valid last point you made. It's the shareholder corporate. It's not an antagonistic relationship. No. It's about saying we have faith and we back you in the strategy. And you mentioned earlier they're multi-decadal themes that are playing out. This, not the short-termism. It's going to require a bit of effort and maybe some sacrifice and some capex focused on the right areas. But the idea of sustainability, it's not that short-termism. It's about looking beyond the next horizon and making sure as stewards of our clients' capital that the portfolio and the way that we manage money is planned for that regard. So, Delphine, thank you very much for your time today. Those 25 minutes absolutely flew, didn't they?
Yeah, they did.
And we look forward to catching up soon. And from myself, David, thanks for joining us for the responsible investment segment of today's day, and enjoy the rest of your morning and the webinar. Thank you very much.